Welcome back to IM Academy's foreign exchange course. In this video lesson, we're going to be diving into chart formations, really understanding how to read the market's story. Now, chart formations reflect the collective behavior and psychology of market participants. And by studying these patterns, traders can gain insights into the underlying sentiment driving those price movements, whether it's fear, greed, optimism, or uncertainty. Now, chart formations are more reliable when confirmed by other technical indicators and volume analysis. For example, a head and shoulders patterns that you're going to learn about later, followed by a significant increase in volume on the breakout, enhances the likelihood of a successful trade. Now, there's two different types of patterns. The first is known as reversal patterns, which indicate a potential change in the trend's direction. Examples include head and shoulders, double tops, and inverse head and shoulders. The continuation pattern suggests that the existing trend is likely to continue. And examples include flags, pennants, and triangles, all in which we're going to cover inside of this video lesson. Now, for the first type, we're going to focus on reversal patterns. A reversal pattern indicates a potential change in the market's direction of the current trend. Now, head and shoulders consist of three peaks, as in the figure shown on the right, the left shoulder, the head, and the right shoulder. The neckline, drawn by connecting the lows of the two shoulders, is the breakout point, okay? So there's a support level that's created at that low of each shoulder that comes in line with the head. Now, that support level is what's known as the neckline, and when the price breaks below the neckline, it signals a reversal from an uptrend to a downtrend. Similarly, inverse head and shoulders now has the head below in a downtrend, two shoulders on the left and right. The neckline are the two highs of the shoulders that are brought together, creating a resistance, and when the price breaks above the neckline, this indicates a reversal from a downtrend to an uptrend. You're also going to start seeing a lot more double tops and double bottoms. For the first, formed after an uptrend, it features two peaks at approximately the same level, indicating a strong level of resistance. A break below the low of these two peaks confirms the reversal, which is known as the neckline, okay? On the other side, there is the double bottom. This appears after a downtrend. It's characterized by two lows at roughly the same price level, indicating support. Now, a break above the high between the two lows are what is the neckline, and that's going to go ahead and confirm the reversal. Something that you're going to see automatically that shows up on many charts, when you log on to an online charting platform, is the volume analysis. Now, volume on the bottom of the screen are the blue bars going up and down, and all this is showing you is increased volume or decreased volume in the market. That means the amount of number of orders that are being executed and filled. So when you see increasing volume that typically increases during the breakout of these patterns, this adds validity to your reversal signal. Anything in an increase in volume, paired along with anything else, is going to show you that a rally or a breakout is coming. Now, continuation patterns, as opposed to reversal patterns, they suggest that the trend will resume after a period of consolidation or correction. And there's a few different types. The first is known as flags. It's formed by a small rectangular or parallelogram-shaped consolidation period sloping against the prevailing trend. For example, downward sloping in an uptrend. And the bullish or bearish signal in these is that a flag forms with a downward slope, and in a downtrend, a bearish flag forms with an upward slope. So it's like the opposite of the direction of the trend. And these are continuation moves. Now, the breakout in the direction of the prevailing trend signals a continuation. You also have what's known as pennants. Pennants are very similar to flags, except they're like small symmetrical triangles. They form after a sharp price movement and represent a brief consolidation period. A breakout in the direction of the prevailing trend confirms the pattern. Notice the similarities here, where a breakout in the continuation of the prevailing trend confirms. So we always, as trend traders, are looking for what's in the direction of the higher time frame trend. Now, common mistakes to avoid are understanding and identifying chart formations are crucial, but it's equally important to avoid these common pitfalls that can lead to costly mistakes. Being aware of these mistakes can enhance your analysis and improve trading outcomes. And the first of which is over-identification. Seeing patterns that aren't there due to confirmation bias. I know this isn't a downtrend. I know it's in an uptrend. But you don't know until you go and do the market structure. Only valid patterns that meet strict criteria should be traded. The solution is ensure patterns are clear and meet all the necessary conditions before acting. Use multiple time frames for confirmation. The next is ignoring volume. Neglecting volume can lead to false signals. Volume should support the pattern. Increasing volume on breakouts adds reliability. So always analyze volume in conjunction with price patterns. Look for volume spikes that confirm the pattern's validity if that's a part of your trading strategy. Now, premature entering trades before a pattern is fully confirmed can lead to false breakouts and losses. So what's the solution? Wait for the breakout and confirmation of the pattern before entering said trade. And use closing prices to confirm breakouts. Where did it close? Did it close out of that range? Did it close below that support or above that resistance? These are all important things to know. Another mistake that you can avoid is trading without stop loss orders. That can lead to significant losses if the trade goes against you. So always set stop loss orders at logical levels, such as outside the pattern's boundaries, to limit potential losses. And if you're over-relying on a single pattern, then it's going to lead to missed opportunities and increased risk. So you want to diversify your analysis by incorporating multiple patterns and indicators to get a more comprehensive view of the market. Okay, now these indicators can be confirmation, can be price action, doesn't have to be a bunch of lines on the chart. Okay, it can just be the candles itself. As we continue these mistakes that you're going to be presented with, we have to include ignoring broader market trends. Not considering the overall market trend in context can lead to trades that go against the prevailing market direction. So you always got to analyze chart patterns within the context of the broader market trends and other relevant factors. By overtrading or pattern chasing, continuously seeking out patterns can lead to extreme overtrading, which increases transaction costs and risks. So you got to be selective and only trade high probability setups. Quality over quantity is key. Now, avoiding these common mistakes can significantly enhance your ability to successfully trade chart formations. By practicing disciplined analysis using volume confirmation, waiting for pattern recognition and confirmation, setting stop loss orders, diversifying your strategies, and considering market context, and definitely not overtrading, you can too improve your trading performance and reduce the likelihood of costly errors. Review your notes for this video and continue the next video here inside of our Trend Trading series.